Welcome to Wall Street Confidential on TheStreet.com TV. I'm your host, Farnoosh Torabi, talking about the current money flow in the market right now. We started the new year on a dismal note, and bond yields are going down. A lot of money heading to the Coca-Colas, the Altrias, the Pepsis of the world.
Just today.
Just today. Jim, I'm a little uncertain about this. I mean, is this sustainable, this sentiment?
One of the things that happened is that these stocks had a very big run, and then they came in for a lot of profit taking. The profit taking was twofold. One is that the multiples are very stretched. These stocks are not by any means cheap. And the other thing is that the raw costs have gotten out of control. When the bond yields go down, the people who favor and believe in multiple expansion, because obviously the longer term, these are all assets, the longer term asset growth of an equity that has consistent earnings gets boosted by interest rates going down. But it doesn't answer the raw cost issue. I think a Pepsi or a Coke, they're consistent, and today consistency is trumping anything involving raw costs. What I worry about is that these stocks were boosted by the fact that the economy was slowing, and also because of a weak dollar. Dollar's really no longer weak. You still have the economy slowing. If you get a number, an employment number tomorrow that shows any strength, I think that the move will be undone.
Now, Pepsi, and you're saying that these are stocks, Pepsi and Altria specifically, Coke and Altria specifically, are the companies where they can actually counter the rise in inflation.
Well, you go back, Coca-Cola said that their raw costs peaked in the last quarter. Altria is a company that has very little exposure to a lot of these. This is really just a tobacco company. And by the way, I see Anheuser-Busch, they're talking about raising prices of beer. Wouldn't be surprised me to see tobacco prices raised. So those are less immune, they're more immune. Pepsi's kind of intriguing, if only because they're moving more international, so there's a good secular story. But the Frito-Lay raw costs are bad. The Pepsi itself raw costs are good.
You're saying, I want to mention, you said money's flowing right back into Medco Health. How does that relate to this whole
Medco Health,
sphere?
The essence of what's moving today is consistency and visibility. There's great visibility, obviously, long-term to packaged goods because they sell in times of slowdown. Medco represents the greatest visibility of all. So you're trying to choose between a 5-year bond and a 5-year stock. The earnings quality of Medco is incredibly good because of the fact that as drugs come off patent, it is a winner. That's what it does. Which is surprising me, by the way, with CVS. CVS has gone from being a loved to a hated stock in one day. I read Stock Picker. It's remarkable how much it's suddenly hated. What I like to look at is, I owned it before. It's back at my basis. So obviously I'm wrong to have not sold it at 39. But CVS is a Medco play with the drugstore business, and I would own CVS and sell Walgreens off today's number.
All right, thanks a lot, Jim Cramer. I got 2 for 1 there. I want to talk to you about another video about CVS. Sure. This is Wall Street Confidential. Stay tuned for more.